Hey Sandy, hey April. So with the Zoom, I'm gonna email you guys the PowerPoint because you guys are the two people on Zoom and Jessica's out today, so I don't know how to access the ability to share my screen because
Okay.
Melba is in the big conference room, so we're in the small one. So I'll just email all three of you guys the PowerPoint and yeah, that'd be great, just in case.
I think Rachel's joining too.
Okay. And then Famita's in here as well. I'm gonna send all of you guys the PowerPoint for the class right now.
Perfect. Thank you.
Yep,
Thanks, Hunter.
sorry about that.
I need my email.
Oh, no worries.
Yeah, absolutely. Yep, go ahead.
Ivan, I-V-I-N.
Yep.
Medina, M-E-D-I.
You said it's IVAN, right?
Yeah.
Yeah, okay.
Yep. Medina, M-E-D-I-N-A.
Yep.
JW.
You got it. Richie, you want me to send it to you too?
Huh?
I'm sending you the PowerPoint as well.
Okay.
All right, so then I'll go ahead and get started. We're gonna try and figure out the Zoom stuff. We're just not in the correct room. Cam, I'm gonna send you the PowerPoint as well. Okay. Then I'll go ahead and get started. Okay.
I'm sorry, I'm sitting here by the door and got some stuff going on.
Yes, no worries. Yeah, absolutely. All right. Okay, so I just emailed everybody the PowerPoint. I'll go ahead and get started. So just for your information, we are not involved in the loan assumption process. So with that being said, I have listened to a few podcasts. I did a bunch of research and I had a PowerPoint put together on loan assumptions just because I think that it would be of good help and advantage for you for general knowledge for any of your clients that may be looking at a listing that potentially has a home that's listed with an assumable loan in the I guess the listing. So for all you guys online, if you have any questions, just stop me. I can hear you. I turned my computer all the way up, so you guys kind of have a view of the room, but I'll just be going through the PowerPoint. Can you guys hear me okay?
Yeah.
Okay,
Hey,
so
hey, Hunter, did you already send the PowerPoint just now or are you
I-
sending it later?
I did send it. I think that I'm about to be able to share my screen though, so it might.
You should
cool.
be able to now, Hunter.
Okay, cool. Let's see. Yep, I'm able to. So that's.
Oh, and I just got the PowerPoint too. Okay, cool. It was just a little delayed.
All right, there we go. So, okay. Y'all just stop me if you need anything, but here is the PowerPoint, so that's perfect. Sorry about the delay. But as I was mentioning just a second ago, so for loan assumptions, we're not, yeah, perfect. We are not a part of the loan assumption process unless we are the servicer of the loan that is being assumed by the buyer of the home. So we'll get into everything. As I mentioned, I did a bunch of research on this. It's a very interesting project or product, be able to do this for your client. So having the knowledge on it, I think is very good, especially in the climate of the market we have with some rising interest rates. So here we go with loan assumptions. So what is an assumable loan? So this provides the buyer of the home an opportunity to purchase a home by taking over the seller's mortgage without applying for a new mortgage. With that being said, the terms of the mortgage will remain the same. So if the home is being sold for $400,000 and this seller has owned the home for, let's just say 8 years, and the mortgage balance is now $250,000, the client will be taking over the $250,000 mortgage. So they're not necessarily putting 5% down on a $400,000 home. They are assuming the $250,000 mortgage that is already available. Now we'll get into the down payment and what goes on with the equity, how we're going to bring cash to close and all that stuff. But just for your knowledge, throughout the presentation, it is basically just if Richie owns a home and I'm assuming the loan from him and he has a 2.75 interest rate with a $250,000 mortgage on it, I am going to take over that mortgage with the same servicer, the exact same terms, just the liability is moving from Richie to myself. And that's really the assumption of the loan. So you're assuming the same terms. And so that's where it says the responsibility of the debt is then transferred from the seller to the buyer of the home. Okay, so there are some loan assumption requirements because not all loans are assumable. And I'll just put it out there to say that I would say most conventional loans are not assumable. If they are an ARM product, they potentially could be assumable. And I'm trying to do more research. I'm not 100% sure why that is. However, FHA and VA loans are usually assumable. Hey, Ashley, how's it going? I am good. Thanks for coming. No, you're all good. And then I'm happy that she'll be able to kind of speak on the assumption process through the closing attorney's eyes. But with that being said, the requirements are the current servicer will have to advise if the loan is assumable. And then if so, they can provide the documentation required to proceed with the assumption. This process takes about 45 to 90 days. It's a little bit longer. You have to contact the servicer. So it's not necessarily you're talking to a loan officer who then has to go up the chain of commands to whoever is servicing the loan. They have to make sure that the loan is assumable and then go through all the necessary steps in order to.
That's the main thing you need to tell somebody is that,
Yeah, absolutely.
because that's timing.
But the good thing is with the assumption of the loan and the timing, as you mentioned, the interest rate cannot fluctuate.
Right.
So if they are waiting on the market per se,
Yeah.
it does take a little bit longer, but that interest rate is the
That's
interest
fair.
rate from the loan. So it's not like they have to worry about, the market dropping one day or going up or whatever that may be. So the process does take a little bit longer, but hey, maybe you have a seller that is moving in 3 to 6 months and you want to go ahead and say if the loan's assumable, hey, we'll buy it in 6 months, we'll start the process in 2 or 3 months, and then we'll just assume that loan whenever it's time for you to move. So it's kind of it's a nice product for somebody if the loan is assumable for them to kind of transition out of their home freely and there's not too many moving parts with it until you kind of get to the closing process. So
Well, honestly, the closing process is not that different. So if it is assumable and they meet all the qualifications, then they're fine. The only difference is a couple of the paperwork or a couple of the documents are gonna be different. It's not really gonna be like a new note, you're assuming the old note. So there's some assumption paperwork, but the actual closing process isn't too terribly different.
right. And then with that being said, the buyer is still required to pass the qualifying requirements for a mortgage, but what I think is very interesting about the product, so instead of the borrower having to qualify at the 7% or 6.5% rate that they're at right now,
Right.
if they're assuming a loan that's a 4% interest rate, that's what they're getting underwritten
Oh,
based
that's
off of.
interesting.
So,
That's the biggest part of it.
yep, that helps as
Nice.
well. And then the assumption does not take into consideration equity, so we'll get there, but if it is a $250,000 mortgage on $400,000, it is not taking that $150,000 in equity into account. It's basically just the mortgage provided. So
But
the
it's the loan balance that you're assuming or.
correct, the loan balance, but you are assuming the property as well. So we'll get into how that all works with the cash to close and all that
So the
good
person
stuff.
that qualifies for mortgage has to qualify for 400,000 or for 250?
250, whatever the mortgage balance is.
So that's what you qualify.
Yep, absolutely, yep. And then, so that kind of makes it easier for some people to transition that at home, especially if the mortgage balance is lower and they have some cash on hand, but they may not have the income to show it. This, I think, is very interesting for self-employed borrowers, maybe who write off a bunch of stuff. They don't show as much adjusted gross income, so they can't qualify for as much financing, but they may have some extra cash to be able to, come to the closing table with the down payment required. So here's an example of a loan assumption. So kind of what we were talking about, just a different purchase price. So the seller has a loan balance of $250,000 on a $300,000 home. So this is where I was getting into the cash to close needs with the equity. So the buyer will need to bring the $50,000 to the table to compensate the seller for the equity that they have in the home. So one thing that I would like to mention here about assumable loans, if you have a client who may be buying a house from their parents or buying a house from their relative, and they're not necessarily looking to, gain, proceeds from the sale of the home, and they're really kind of giving it as a gift to the family, then, maybe you've seen this before, but if they have $250,000 balance on the loan and they want to sell the house for that amount, then there's not necessarily money that needs to be brought to the closing table. Now, the down payment requirements, and if they can have 100% financed off of the purchase price, I believe that's okay, but I'm not
That's the
100% sure.
difference on appraisal, right?
There is no appraisal
Oh, there's
required.
no appraisal.
No
Okay.
appraisal required for a loan assumption.
Oh.
So, yeah, that's what's nice. Hey, how's it going? No, you're good. So with that being said, a home equity loan is a common second mortgage. So a HELOC is how we like to refer to these. It's a good option for the buyer who does not have the cash to cover the equity to the closing table. So what they can do is they can actually get a HELOC on the property that they are assuming the loan from. So if they don't own a residence right now, they don't have to get a HELOC on that residence. They can actually get it on the property they're assuming the loan from. So if it's a $250,000 mortgage, they want to get a $100,000 HELOC, pay off the, cash to close, and then they can either, get that appreciation in the home, pay back the HELOC, however it may be, because it is a monthly payment that is added on to the mortgage.
Right.
So however they want to do it, but it's a great way to transition to the house. I mean, not everybody right now has $50,000 laying around, so it could be an option for them.
So basically, they have to qualify for that balance of the home, plus it's only
Plus the
cash
HELOC.
for the
Yes,
HELOC,
yes.
yeah.
And so the monthly payment on the HELOC, that's where it's nice, because we can put you in contact with people who do the HELOCs. That'll do standalone HELOCs, which would be,
Could be interest only,
that's a good question. I've never,
like most of them are.
so I've brokered a HELOC before, that was interest only. I'm not 100% sure how the person that we
Yeah.
connect with does the HELOC. Is that what you see, mostly interest only HELOCs?
I see, no, Yeah.
I was
Yeah, the
thinking
other way.
Yeah,
yeah, I think is more common, but I think that's just a discussion between the borrower and the lender that shelter can get you in contact with, is setting that up. I think the other important point on that is that with the HELOC, what the rate that they're qualifying for is like the current market HELOC
Sure.
rate, it's not the reduced rate.
Correct.
So I think when you
Yeah.
explain that to your buyers, that's if they are gonna go the HELOC route or just like a second mortgage, know that part they would have to qualify at the current rate.
Which is more non-typically.
yes,
But most HELOCs that I've seen have always interest only, unless you want to pay more, it's like a credit card. You know, 2% that you have to pay minimum payment, so I don't know which one they will get, they will use to qualify you, the minimum payment, interest only, or.
Yeah, so
How
that
much
would be
that
a
is.
question that we'd all, talk with either the servicer of the loan and the loan officer, or whatever the term is for people who originate the HELOCs. I think that might be their title as well.
Sure.
Just have a conversation with them, make sure that everything qualifies, and then again, it would really be up to the servicer of the loan. So, and then with that being said, the second loan, like Ashley just mentioned, and Ivan did as well, will have a higher interest rate than the assumed mortgage. However, the principal amount will normally be lower on the first mortgage. So, if we're talking about financing $250,000 at a 3 or 4% interest rate, it's going to be a lot cheaper than the 7%. And then when you add in the HELOC, your monthly payment is still probably going to be below. So that's something that even though we don't, help with the assumption process, we can make that make sense to the borrower. We can give them an IMW and add in the HELOC costs as well as the difference between what the note rate is and their assumed rate, to kind of make it make sense to the client of how good of a deal they're actually getting. And then, so there are two types of mortgage assumptions. A simple assumption is actually against the law. So what that is, it's the transfer of responsibility from the mortgage, from the seller to the buyer being private. So they don't keep the lender involved in the process. There's no underwriting that goes on. And then, so this is very tricky because if the buyer fails to pay the mortgage, the seller is also responsible because they're going to be the one whose credit report is currently on. Because without the legal procedures of transferring and assuming the mortgage and the deed of the property and all that good stuff through the correct channels, like Ashley, and talking to the servicer of the mortgage, that's basically just you're renting the house out and paying for the mortgage, but you're not responsible for it. So it is technically illegal. And novation is the term for a legal assumption of a loan. It's when the lender is involved and they agree to transfer the liability of the loan from the seller to the buyer of the home. And the buyer, as mentioned, goes through the underwriting process in order to accomplish this. So with that being said, I've seen some simple assumption stuff through creative financing. And so I guess that kind of is a little sketchy.
Yeah, it's very sketchy. So what people will ask you for with this simple assumption is a wraparound mortgage. And so Hunter's exactly right. You don't ever want to be participating in a wraparound mortgage because it's not just that like, oh, the seller is, could be kind of hurt. It's definitely going on their credit report because it's their name that's still on the loan, right? And when it's a foreclosure, now it's a foreclosure on the seller's credit report. So if you represent a seller, a wraparound mortgage is not ever a good idea. And that's what, people don't typically say simple assumptions. I think everyone knows that that's not a legit thing to do, but they say, oh, I'll call it a wraparound mortgage and then it's fine. It's not fine. Like we won't do that closing because also we represent the lender, right? So for us to be part of something that cuts a lender out of the picture entirely doesn't help our cause.
Wraparound mortgage.
What?
No one anymore,
Right.
but that used to be a thing.
Yeah, but it's not anymore. And because each security deed has what's called a due on sale clause. So you're breaching the security deed by selling the property without paying off the security deed, unless you get the lender's approval and do an actual novation, which goes through the proper channels.
Which is a nice segue because I have the due on sale clause here in just a minute. So,
Look at that.
and so, yeah, with that being said, I mean, you could technically consider the simple assumption mortgage fraud as well, because it's almost like the seller is qualifying for the buyer to get the mortgage. So there's multiple ways that it is technically illegal.
Mhm. I guess so. I don't know what I'm doing.
And then, so as I mentioned, FHA loans are usually loans that will be assumed those for VA because they are government-backed loans. So all FHA loans originated on or after December 15th of 1989 are generally assumable. So we'll put generally in quotation marks because it really just depends on the servicer of the loan. So the review requirements may consist of a credit review. So just your normal mortgage credit review with secondary financing. So that's if you have a piggyback loan, a HELOC, a secondary mortgage in order to qualify and or pay for the down payment. That is going to be considered as long as the repayment terms of the loan is clearly defined and going through an underwriting analysis. So basically you just talk to a lender or the servicer of the loan. And then seller contributions, cash contributions from the seller for the assumption is not allowed. So they can't list the property at 400,000. You assume the $250,000 loan and then the seller gives you $15,000 towards your down payment. Just like on a standard loan, that is not allowed. So they can give concessions towards closing costs. They're not allowed to help you with a gift of equity towards the down payment. However, if they want to list the property for less, that's one way to go about it. As we mentioned, if it's a family member or a friend and they're not necessarily trying to gain as much, proceeds from the sale of the home, what they would need to do is just list it for less money and not give a gift of equity after the sale of the home.
I missed what you said, but I'm sure.
No, I'm just saying everything good.
Oh, yeah.
Okay. And
I'm
then
not in
here
trouble.
are, so here is the FHA loan assumption special circumstances. So if there's a death, divorce, or inheritance, the lender cannot check the creditworthiness of the buyer and will not or does not have to approve the transfer. So this is where I guess things would get a little tricky if the buyer who was going through the process either died, was divorced, or had an inheritance and they can't check the creditworthiness of the buyer. This is when the assumption may not be approved. So I just figured I'd throw that on there. Not really, hopefully not going to be happening in a lot of the cases where you guys are potentially doing an assumption. But I thought it was worth noting. Do you have anything on?
Well, kind of on the flip side, like if you own property, we talk about wraparound mortgages and the due on sale clause. If someone owns property and they die and whoever, takes over after their estate, they can typically keep on paying the mortgage, and that's not like mortgage fraud. Typically the lender, as long as they're getting paid, it's still the same person or their like heirs and assigns. That's okay. So I don't want y'all to think that that would be like a wraparound or fraud or something. From the other perspective, these kind of things are fine.
Yep.
Hey Hunter, on the last loan you talked about with the closing costs for the second mortgage, is that eligible for any kind of buy down situation like what we've been doing on first mortgages?
That's a great question. I can get that answer and get back to you. I'm not 100% sure just because I don't personally originate the HELOCs. So I'm sure that they have a creative way to get that monthly payment down a little bit, but I'm not 100% sure what the, parameters of that would be. I don't know if a HELOC includes a 2-to-1 buy down or if you can just buy down the interest rate at a fixed cost. I'll get that information from the guy that we refer people to for HELOCs and I'll get back to you.
Is the second mortgage always going to be a HELOC or could it be?
Oh, so we can do second mortgages. So what that would be is you can, yes, buy down the interest rate on the second mortgage. And what that would be is we would do, so this is kind of a creative way to get out of mortgage insurance, is I'm sure Ashley's seen this as well at some of her closings, is you can do an 80-10-10.
Yeah.
So the client puts 10% down, you get a first mortgage at 80% loan to value, and then you get a second mortgage at 10% loan to value. And so the monthly payment is going to be very similar to if you just put 10% down and you had a 90% loan to value. However, it does cancel the mortgage insurance. So it would basically just save them whatever the monthly mortgage insurance payment would be on the loan. So, I mean, if you have a borrower that's getting a high cost loan or, the DTI is tight, that's something that we always look at. So it could save them, $150 a month. So.
Sure.
Yeah,
Sure.
more
In
money.
those cases, they might be able to get seller concessions for towards that, correct? I mean, obviously
Yes.
not an equity gift, but
Yes,
maybe-
yes, absolutely. So all seller concessions are gonna be, I can send it out again, but it'll be for any conventional loan, if they put down less than 10%, it's gonna be 3%. And then if they put down 25% or 24.99 to 10%, then they can get 6% seller concessions. Then if you put 25% more or 25% down or more, you can get up to 9% seller concessions on a conventional loan.
Cool. Thank you.
And then FHA is just 6% across the board, right? So.
I was gonna ask, is it possible to do a buy down on an adjustable rate, or is that only a fixed rate?
Yeah, so you can buy down an ARM, the adjustable rate mortgage, but you cannot do the 2-to-1 buy down on an ARM.
Okay,
Because and the reason being is if you put it in terms of what the mortgage product is, so an ARM would be, our best pricing is our 10-year ARM, which is a little counterintuitive to me. You think it'd be the 5-year ARM, but it's the 10-year, which makes me more comfortable, and I think the client's more comfortable as well, because it's fixed for that period of time. But since it's fixed for the 10-year period, and then it's going to be variable after that, you can't buy down the buy down, essentially, because an ARM has a built-in buy down, because your interest rate's going to be half a point better. So just the way that works in the qualified mortgage standards, we cannot buy down the buy. So, but you can permanently buy down the ARM farther than what it's giving you as the par rate, in order to get a lower fixed payment for that amount of time. However, when you run the numbers and do the math, not all the time does it make sense for the client to come out of pocket more to permanently buy that down, especially if they're planning on refinancing.
Sure.
I was thinking because most HELOCs are adjustable.
Yes.
rate, So that probably doesn't exist for a HELOC in the.
Right, I think they could probably buy it
transaction.
down for a fixed period of time, but I don't think that there would be a 2-to-1 buy down. Like, there's not gonna be, unless they've come out with something recently, because the way the market is, nothing that I've heard of though. And then here's another one that we were talking about. So the VA loans, these are gonna be good for assumption a lot of the time. So all of them that have been originated after March 1 of 1988 are assumable if the lender approves. So if the loan is transferred to another qualified VA loan beneficiary, so that's someone else who services the VA loans, they're entitled, or not that services them, but someone that has VA eligibility. Their entitlement takes over, provided a substitution of entitlement. So basically what that is there's a entitlement fee. And I mean, you can kind of speak on this. I'm not too privy to VA loans, but they need to have a entitlement from the VA, which basically just shows that they're eligible to obtain a VA loan. So this documentation would be provided by the VA. You probably have to get it filled out that someone is going to.
So you have to
assume
be
the loan.
you have to be a veteran, I guess.
Well, so that's what's kind of tricky. Not all the time do you have to be a veteran to assume the VA loan. However, through this substitution of entitlement document, there are steps to get there. So I think that you may have to be related to someone that has VA. There's a few requirements. I'm not 100% sure what all the requirements are, but you don't technically have to have VA eligibility yourself.
Oh, yeah, the last point says that.
Yeah. So you're not required to be affiliated with the military. But without this certification, the entitlement utilized to purchase the home will remain tied up there until the loan is fully repaid. So basically, you don't have to be affiliated with the military. However, there are, guidelines and requirements that you're gonna have to go through in order to get that done. So I mean, if you can speak on that, I don't know if you've done any
Well,
VA
it kind of
assumptions.
hurts
No,
the seller a little bit, because if you aren't qualified with your SOE, then the seller's entitlement is held
I
up.
was gonna say, then they can't
So
utilize another
the
VA.
seller can't use whatever remaining entitlement they have left.
Correct.
So it
yes.
doesn't really necessarily, from a seller's point,
Mhm.
make sense to transfer unless it's to another VA.
Which is a
qualified.
great point to note, if you are the listing agent
Yeah.
on.
Cause
a
they
loan,
only,
it's gonna be
they're
so-
only allowed so much based on their service and their ranking and everything when they're
Right.
done.
Yep.
So if they only have 200,000 left, because 350 is tied up there, they want that money back so that they can get that next home that they.
Unless they're gonna, I mean, that's if they're gonna be buying their own home.
Right,
If they're going into a nursing home or something like that, then.
right.
Right, so it's basically case by case basis, which I think is a lot of the times every single mortgage transaction. So it is just a case by case basis depending on who you're working with, but I just think this is good information to know if you are listing a property that currently has a VA loan. And so definitely a question to ask during these times is, what's the current balance on your mortgage that you currently have? Is it, do you own the house free and clear? Do you have a mortgage? If so, if it's FHA or VA, would you be willing to, list your property with or that where the buyer is allowed to assume your loan technically. So in the way that you could list that, I'm sure you guys have seen a couple listings maybe with that in the flyer. That is a very attractive thing for buyers to go look at because you can basically tell them exactly what their mortgage payment is while you're in the house, while you're viewing it. Whereas with another mortgage, you gotta, run the payments, did the interest rate change overnight? What is this? They can tell you exactly what the monthly payment is, which is kind of nice.
And I think that's a great point too, to bring that to your sellers with an assumption is talking about the eligibility. I think most of the time, veterans are pretty aware of how all that works, but you don't want to have the one who hasn't looked at it in
Right.
15 years and doesn't remember it all. You didn't bring it up.
Yeah, and I think it's just another point for you guys as agents to show that you can provide more value than just telling them what their property value is of their home. I think it's just another thing to touch on. And then, after you get done with that client, maybe someone else is talking about assuming loans or they say, oh, my agent said that, last time I talked to them, you should talk to them. So just another added value of knowledge to your clients, I feel like. So here is VA loan assumption continued. So the new buyer would have to meet all VA eligibility requirements. So just like we said, the loan will be underwritten to whatever loan is currently originated to those standards. It must be current. If not, any past due amounts must be paid at or before closing. So with that being said, if the current owner of the mortgage has not paid any of their monthly payments, they're going to be due at the closing table by the seller. So the buyer must qualify based on all VA credit and income standards, just like the FHA loan. Same thing here. The buyer must assume all mortgage obligations, including the repayments of the VA if the loan goes into default. So basically what that means is the new purchaser of the home who the loan is being assumed by now takes over all liability requirements, payments, etc. Just your standard, as every house purchase goes. The original owner or new owner must pay a funding fee of 0.5% of the existing principal loan balance. So if that's $200,000, they pay $1,000 at closing for that. A processing fee must be paid in advance, including a reasonable estimate for the cost of the credit report, which I think is like $6. So it's not anything crazy. And then approval from the VA may be required. And that's once again, based on the servicer of the loan. So
Now, VA loans typically to qualify, you don't have to put a down payment down, so does that transfer over to the buyer?
yeah,
Same-
so on these, there's no down payment required, right? So what's required is that if the house is worth $300,000 and that's what you agree on for your buyer to buy the house at $300,000 and the mortgage has $250,000 on it, they have to bridge that gap. So it's not technically a down payment, but they do have to pay for the equity that the owner currently owns in the home.
Sure.
So here are some of the pros of an assumable mortgage. So with the climate of the market right now, it's lower interest rates. So if there were loans that were originated 2 years ago, maybe they've gained some equity and they want to get out of the current home that they're in, or they're retiring, as you mentioned, or they're moving, whatever the case may be. The lower interest rates are very attractive to buyers, as everybody knows. Somebody heard they could get a 4% interest rate right now. I think they'd be pretty interested in getting that. Fewer closing costs. So Ashley, I think you can kind of speak on the closing costs involved with.
I think the ones that are capped are on y'all's end as far as like the lender fees. Our fees would be
Just
consistent.
standard, yeah.
Mhm.
So basically what I think that this is going with the fewer closing costs is the person who has the current mortgage, the seller of the home, has escrows for taxes and insurance. So therefore the prepaids by the buyer are not necessarily going to be asked to be funded. Is that correct? Because they're already there and they're assuming all obligation of the loan.
if they're assuming the entirety of the escrow account, they probably have to refund the seller. So I don't know that that cost would be different. But I think the
I'll-
different fees associated with the loan are capped.
Yeah, okay, and then there's like, there's no origination fee, so there's no discount points paid because the interest rate's already been locked in for the fixed period of time. And then there's no appraisal, as I mentioned, so the appraisal is usually not required because there was an appraisal done by the person who bought the property and the mortgage is going to be less than what the property appraised at.
Questions are actually probably, can you still get an owner's title insurance under the person that?
Yeah,
Okay.
yeah, the closing process from the buyer's perspective, like as far as the actual closing, as far as I'm involved, is very, very similar. It's just a couple documents are different. It's really making sure they qualify, which would be similar to a standard loan, right? Any borrower getting a loan, whether they're assuming someone else's loan or getting a new loan, is gonna have to go through that process, but they can of course get title insurance. We'll still run title, clear title, set that up.
Nice.
Who do you
Yep,
actually
and
represent in that transaction, Ashley? The original mortgage or any secondary mortgages?
Say that again, I missed the first part of your
Who
sentence.
who do you actually represent in that closing?
So we'd represent the lender still, so it would be the lender whose loan is being assumed. And then if there's a second mortgage, then we represent that lender as well, so all lenders involved.
So if I'm assuming a loan and they've paid on it for 10 years on a 30-year mortgage, then there's 20 years left to pay on the loan,
Yes.
plus whatever your secondary mortgage or HELOC or whatever you choose
Correct.
to take out
Mhm.
is set for 10 years or however long you set that up.
Exactly, yeah, so that's why you'd have to bring the cash to the table to pay for the equity that they've paid off,
Right.
plus the appreciation if they're listing the house for, above whatever they bought it for, which I'm assuming is gonna happen, so yeah, that's where that would come into play.
I think I'll add a pro and let me know if I'm not correct, but usually when you take a 3-year mortgage, the first few years, your amortization doesn't really benefit you at all. You're paying a lot of interest, not much of the principal.
Mhm.
If you assume a loan that's been around 10 years,
Mhm.
now you're paying a lot more into the interest when you make that monthly payment because it's like
Pay a lot
the,
more to
right?
principal.
Yeah. So it's better, that's the pro,
You're
yeah.
exactly right, yeah, because the longer that you do
Yeah.
keep the loan around, the more you're paying towards principal balance and less
Yeah.
interest,
Yeah.
so that's another great point, yeah. The issue with these is finding them,
Right.
so that's the problem, is finding loans that are assumable in homes for sale that are assumable, so. It does cut us out of the process, however, we want you guys to be able to provide value to your clients, so that might be a question you ask to other listing agents. And then, if their property is listed for sale, I think there is a website where you can see the records of how long the mortgage has been on the property. I don't know if I'm making that up. or
Well,
not.
yeah, I can look
Yeah.
up on like the same place I pull deeds, the Clerk County
Mhm.
Authority website, gsccca.org. But yeah, I can look up the information. Now I can't search by property, so I'd have to be able to search by name in the county, that kind of thing. But yeah, I can certainly see when the mortgage was recorded.
So,
And
yeah.
Realist will show that too.
Right,
Okay,
When the
yeah.
mortgage was taken out, it'll show in the bottom of Realist. I just looked at one today for.
Yeah, so you have
And it tells you what kind of loan it is too, whether it's VA, conventional, secondary.
So yeah, I figured there was a software like that, because,
Mm-hmm.
we have some ways to pull some information where we can do that
And
as
it
well,
shows you
so.
what the original loan amount was, so you can kind of make a deduction based on like
How many years?
how many years
Yeah.
it was taken out. It shows you the date it was originated, so.
I mean, I guess you would have to analyze it to determine if the amount of equity in the house makes sense to
Mhm.
assume the loan.
Right, so
Because
my
you may be
thing,
better off
Everything
just
else,
getting your own loan if it's,
depending on if you have a client that has cash, that's why I think that these conversations to be had at your listing appointment or your
Yeah.
buyer consultation are super important, because you can say, what are your goals? If you have a client that has a lot of cash and they want their monthly payment to be as low as possible,
Mhm.
maybe it's the 2-to-1 buy down, or maybe it's assuming a loan and they put more money down into the property. It's just kind of case by case, like you guys know, every single client is case by case, so I think that's why having this knowledge and being able to ask these questions makes a lot of sense for when you're working with someone who potentially could benefit from utilizing this.
I think now because of the interest rate being so high, this will be a very attractive thing. If somebody bought a house years back at 4% even.
Yeah, I mean, if you're listing it, I think this is a great question. What kind of loan do you have on the property?
2%.
Yeah.
It's mostly 8%.
What's that?
If you found a loan like that,
I mean, in the loan.
financially, it almost makes.
The seller has, you're gonna probably know it's assumable or not, right, in the mortgage?
Most likely, yeah,
You know,
but
it's
all
already
you,
gonna be in there.
right, Right, it'll be in all, probably the packet they got at closing on what it says, so.
It's on your closing disclosure. It's either page 3 or page 4. There's a question in boxes up at the top says, is this loan assumable? And it'll say on the actual closing disclosure. So if they still have the closing disclosure from when they purchased it, which I know is a big if, but if they do, then it'll actually be on there.
Yep, and also, like I mentioned, arms are some of the time assumable as well, so some people may be like, no, I don't think it is, but it's worth checking if it is a conventional arm or FHA or VA.
And if they don't have their closing disclosure, then, we would have it on file if we closed it. So unless the law firm's like not around or something, but most of them.
So it just depends on what the loan is, some of them are, some of them are not, yeah,
15 years.
no. If it was conventional, no.
What did you
Um,
ask?
If New res, because I refinanced with them, last year.
Yeah,
So I do not believe so, but it'll be under.
Just a thought, because you.
Yeah.
my mortgage is now with the new resident started out as Countrywide. And that was sold to Bank of America.
I'm sure, yeah.
Then was somebody else, and then new resident ended up with it.
No, it's Halter Bank of America.
So when loans are like
Oh,
transferred to investors, they can't change the
Yeah.
actual loan. So
Yeah.
whatever you had when you got the loan originally, all those
Exactly.
terms are gonna remain
Exactly.
consistent. So your original closing disclosure would dictate that, but I don't think there's any conventional fixed rate mortgages that are assumable at all. So if that's what you have, then, I mean, you can look at your closing disclosure, but I don't think any of them. are.
Yeah, from what I know, there's none that are, but I mean, it's worth a check, I guess, because it could help for sure.
Uh-huh.
Yeah.
So some of the cons of the assumable mortgage, I know I said there wasn't necessarily a down payment percentage that you needed, but there is a technical down payment because of the cash to close. So if the seller's equity is high, your down payment may be far higher, or you may have to take out a second loan to
Right.
potentially cover that difference. So it really, again, is a case by case basis. So the credit and income requirements, most sellers won't agree to assumption unless you meet the lender's credit and income requirements. The sellers will not be released from the liability if not. If they do that, it's illegal. So they're going to be liable regardless. A note for VA borrowers is your VA entitlement will not be available until the assumed loan is paid off unless the buyer is a qualifying veteran with entitlement. So that's what I was speaking on a little bit earlier, and what you guys were mentioning. So if they're looking to buy a new home, this is not going to be beneficial to the seller unless the qualifying party is a veteran and they can assume that VA loan and have entitlement themselves, because if not, then the seller is going to be locked up and have their hands tied and potentially not be able to qualify for another VA loan, which is not, number one, not the best thing for them, but they could go conventionally or FHA, but they won't be able to use their VA entitlement, which is, I think, a big benefit to being a veteran and being able to help them out. So make sure if you have a VA seller that you're checking this out. And then the potential fees, you may be required to pay a loan assumption fees or ongoing mortgage insurance. Once again, it's based on the seller or the servicer of the loan. So I don't know what the loan assumption fees are as far as the closing attorney. You said they were just,
It's just, it's a
standard
regular
fees.
closing
Yeah.
for us, yeah.
So yeah, just those fees kind of depend on the servicer and if they're going to charge a fee for the assumption of the loan.
Or another thing that's a pro there is that if you buying. If you get in that loan assumption on a loan that's been around 7 years. And it's marked that the 10th year it eliminates the PMI.
Yep.
Then you only got 3 years to go, and whereas originally you would have had to go the whole 10 years.
Yep. And so that's a good point too, as far as the PMI is concerned. So what I always do, especially with the appreciation, the way that it's been the past 2 years, is I always check up on clients after 2 years, because if you want to get an appraisal done and the appraised value then
Right.
has the loan amount at 80% loan to value, it is required that they have to pay mortgage insurance for 24 months if you don't put 20% down. But after that 24 months is up, if their house appraised for more than 80% loan to value, then they could cancel it by just contacting the servicer. So that's always a good touch, especially if you're an agent, you have buyers that bought a home maybe you reach out, say happy 2-year, home anniversary. I highly recommend you connect with, Stanley Matter, Hunter, whoever, if we did the loan, connect with them, talk to the servicer and see what your loan to value is at, see if we can refinance.
Yeah, we were bought before now, 2018 probably,
Right, I would say whoever bought in 2020,
2020.
yeah,
or even 2020.
right, so.
Is that the case for conventional and FHA?
So for conventional, yes, FHA mortgage insurance is required throughout the life of the loan unless they put 10% down. So if they put 10% down, you can cancel your mortgage insurance after 10 years. But there's no really, I guess,
Well, refi, I guess, at that point, right?
yes, but if you refi into another FHA loan, then it would be another 10 years, you gotta pay for
Yeah.
the insurance. So it really just depends. And then I would say, if you're in the loan for 10 years and you put 10% down, you're 100% gonna be at 80% loan to value, so you can cancel at that point. But I would say there's probably not many FHA loans that have been, serviced for 10 years, so they probably refinance out of that. So, but it's still a good touch, if you want to talk to somebody and just say, happy home anniversary. Now that you are below 80% loan to value, if you'd like to refinance into a conventional loan, that's a great way to get your mortgage.
Or they have the
as well.
cash now to put 10% down. on the
Right.
refi, right? Then
Yeah.
probably.
Exactly. So either way, however you like to go about it. I just think right now with the rates, there's probably not a good refinance opportunity for the next year or so.
Sure.
But then when that happens, then you refinance out of the rate, we get another appraisal done and you're out of mortgage insurance. So that's gonna be big for us in the next couple of years.
Yeah.
Conventional loan assumption, as I mentioned, most conventional loans are not assumable because the mortgage contract contains a due on sale clause. You want to talk about the due on sale clause?
Yeah, it literally means the mortgage is due upon the sale of the property, so due on sale, and that's part of the security. It's why in every closing, you see us paying off the seller's mortgage, it's because they're paying it off, and then the buyer's taking out a new loan. So this is really kind of to prevent the wraparound mortgage situation too, right? Because if I sell it to Hunter, but then Hunter just wants to pay my mortgage, my lender can say, no, you sold it, the whole thing is due. And then we have to pay the whole thing, even if if I didn't sell, I might have 15 years, but because I sold it without either paying it off or getting their approval, they can say it's all due now. So that's certainly another risk with these wraparound mortgages, past it being not okay with the lender, past it being a horrible idea for the seller, is that also they could say the whole thing's due. And then obviously there's gonna be a huge argument between the buyer and the seller as to who's gonna pay this lump sum of a mortgage that neither one of them really has the money to pay for.
Yep, and that's why sometimes sellers are a little, it might be on the Alta, it's on some of our documents too, when you send it out, because when we pay for the loan, we pay off, well, when we fund our loans, we pay off the entire current mortgage. And then we originate our new mortgage amount for them. So sometimes the client sees a total due, $300,000 above the purchase price, but that's because we're sending money to pay off the current mortgage plus funding our own mortgage. So I've had some questions like, oh my goodness, like what is that number? But it's just for the mortgage side of things to make sure everything's in order.
Like on
So-
the settlement statement at the very bottom, is that what you're talking
yeah,
about? Yeah, that's literally just an accounting tool. So the way it works for both sides is there's amount due from a side and then amount due to a side. So you get to the bottom and what's due from a seller and what's due to a seller is gonna be a huge gap. So that's why we have to pay the seller. But then the very last number is just the total amount due from them, the total amount due to them, and they're gonna match. And those numbers have no actual value at all. It's literally just an accounting tool to make sure we're sending the seller the right money or collecting the right amount from the buyer. Yeah, but sometimes, and that's a good thing to point out too, whether you represent the buyer or the seller, is I had a closing a couple of weeks ago where the agent told the buyer to send the very last number on the settlement statement, which is fine because it was way more than they had to actually pay for the mortgage. And then I've also had sellers come and say, well, I thought I was going to get this much back. And really it's the amount due to the seller that they get, not the total. So knowing kind of those, so it's on each side, there's two numbers and then the due from, and then two numbers. So these four on each side have no value at all.
Which I think is interesting. If people see that, they're either really happy or really upset. It's
Uh-huh.
usually a lot different than those numbers. So that's why I figured I'd point it out,
Yeah.
just because that's
good.
kind of where we're looking at. The due on sale clause allows the lender to demand you pay the entire remaining loan amount as soon as the property is sold, as Ashley just mentioned. However, as we mentioned earlier, if you have a conventional arm and meet certain financial qualifications, it is possible your mortgage is eligible for assumption. So once again, you got to contact the servicer. Just another good question, another good piece, asking if they have an arm, if it's conventional loan.
And if they don't know what kind of loan they have, that's also on their closing disclosure. So it'll be on the first page as to what type of loan it is, and then either, I think it's the third or fourth page, whether or not it's assumable. So you can look there for all the information.
Yeah, and if they don't know what type of loan they have them call us next time, because they definitely didn't talk to the right person if they don't know what kind of mortgage they have.
Well, you'd be surprised. I sometimes have sellers who just didn't think they had a second mortgage because they thought it was free money, but they had a second mortgage. And that doesn't mean that the lender and the agent and the attorney failed. They just like legit forgot. And I see it all the time, because there's no way there's that many agents, lenders, and attorneys who are totally failing to explain the second mortgage, but especially with down payment assistance programs, like
Yeah,
I would say 60 to 70% of the people don't actually remember that it's a mortgage.
that's good to know as well.
Whoops.
Whoa, yeah, big whoops, because a lot of, especially with the down payment assistance, which I guess we're starting to see a little bit more of and are probably gonna come back because, sellers are actually accepting offers that might need that down payment assistance, is that a lot of them are set up to get forgiven after 5 years or 10 years. I think 5 years is the most common, but some of them, like if you pay or if you sell the house within those 5 years, you have to owe the whole thing. Some of them like reduce per year. So if you sell in year 2, then you've already earned the 20% from year 1. You just have to pay the 80% remaining. So knowing if they have that program, how it was set up is important. It makes a big difference because that's not super
But
fun.
that's typically in the city of Atlanta, or is it throughout?
There are different down payment
Yeah.
assistance programs based on the area, so we actually have one we're about to be able to use, I think it's called Atlanta Communities, is what it's called. We're getting more information on it, but we should have it active soon, if it's not already active, we should have to take a training on it, but I think that's big, because a lot of people do ask for down payment assistance. But I will say, the down payment assistance, we need to make sure that it's good for the client, because sometimes, like she said, it's financed over a 30-year
I think
period,
people
so.
think that when they hear that, they think it's
It's free,
like,
yeah.
they think it's a
Like
gift. or
90% of the time, they think it's a gift. And I can tell them at closing, it's not a gift, but I promise you, they're not gonna remember that. So,
Hell,
So
that's
it's rolled into their,
free.
yeah. And part of it is they wanna make sure like that they're assisting people to buy a primary residence that they're actually going to live in for a set period of time, right?
Right.
Like I could say it's a primary residence, but if I move out in 6 months, well, was I really the person that they're trying to help? They're trying to help people get a home.
Yeah, it's supposed to be able to
And
establish homeownership
Yeah.
goals and dreams for Atlanta residents, so it's not for them to buy a house, move out and rent it out.
Right.
Basically, so, and that's why it's the 5 year, there's a 5-year rule on a lot of them, because they do live there for 5 years, and sometimes it is forgiven, because they think that that grant then did its job.
Especially there's different
Exactly.
kinds, just, I've only seen it in Atlanta. I've seen it
Yeah,
in
so we
Atlanta,
have like
there's
we
different-
DeKalb and we Cobb, where like you have to buy a property in the city of DeKalb or the city of Cobb, or it's either city or county, and it's different depending on where it is. There's one in the city of Atlanta, and then DeKalb County, Cobb County,
Okay,
and then the Atlanta communities, one that I was talking about, I think is all Metro Atlanta. So we'll get more information. I'll probably do a class on that once I take the classes that I have to take in order to learn about it and then be able to provide it to people. But I think that'll be a big assistance, but we'll get all the information on if it's forgiven after a certain amount of time and how that looks.
And
So
it's certain amount of time and making all of your first mortgage payments on time. So if you miss a mortgage payment, you're not gonna get your like down payment assistance forgiven.
that's important.
Yes,
Yeah.
that's well,
definitely.
you
All right.
make them on time.
A little hiccup and then.
Don't get late and
With that being said, we got pizza in the conference room because they moved out. Renee's got pizza in there because they're going to be transitioning into Marlo's class in here afterwards. So if you guys have any questions, comments, concerns for Ashley or
Our
I,
class is gonna be in here.
I believe
No,
it might be in
I
the conference room,
Yeah,
but they're trying to
it's in
just
our regular-
flow us directly in there. So people are going to be eating in there. They're taking Marlo's class.
Right.
And then we're gonna, because Melba had egg and egg before
Oh,
this, so
pizza.
just ended. So if you guys have any questions, I'm always available. Give me a call. Thank you guys for coming. Anybody?
Thanks, so much.
Yeah, anybody online got anything before we wrap up?
Not till we heard the word
Thank
pizza.
you, Nate.
I know it's,
Yeah.
hey, Hunter, they're just talking about that loan assistance, and I know your down payment assistance, I know you're gonna do something else on it. But is that an amount that's actually rolled into the first mortgage? Is that how that works, or is
So
it?
it's usually a second mortgage. And so it's not necessarily rolled in, but if you consider it, you could consider it rolled in because they're gonna be paying for it at the
That's what I'm
same
wondering.
time.
How
as
are they
your first
paying?
mortgage.
That's what I was wondering,
So-
how are they paying for it?
So
Don't pay for it month to month. Most of them you don't pay for it. It's like just exists, and then if you sell the house, you pay it back.
So,
Or
yeah.
It's forgiven over a period of
So
time.
it literally is a grant.
it depends on which program you use. Like Georgia Dream is, I've done one of those, and that's financed over a 30-year period.
Okay.
So it's basically my example is I got $7,500 for the client for her down payment assistance at closing. And then she was paying, I believe, $37 a month for 30 years to pay that back. So it's financed into it. It just makes their monthly payment a little bit higher. But if it's someone that's, very qualified for the loan, they're just looking for a down payment help and they can pay that off monthly, then that's kind of how it works.
Yeah, they're just
Or at least Georgia
cash
Dream
out.
does. Yeah,
But those would probably not be forgivable.
correct. It's not
financed over
forgivable.
the
Yeah.
30-year period.
Yeah, those are not forgivable.
Yeah, that's just for somebody that probably qualifies, like you said, perfectly fine, can make the payments, but doesn't have any cash.
Correct.
Okay, I see. So it's a couple different programs depending on the situation.
Yes, and not all lenders have them. And also like what I was mentioning on WeCobb and WeDeCab, there's a fixed amount of money that they have at the beginning of the year in their fund to give out for the down payment assistance. And this year it's already been depleted. So there's no more money in either of those accounts. So we can't currently do any of those until January 1st.
Okay, gotcha. And those are probably grants in those programs.
Yeah, I believe so. Yeah.
And so if they're like not forgiven, like they have to get paid off, or it turns out that they didn't really need it, then there's pretty significant tax implications.
Yeah, I
So
bet.
they essentially get on the hook for repaying all the tax benefit that they received from getting this grant, more or less.
That makes sense.
And I will say, I highly, highly recommend people to stay away if they can from that, because it does cause many hiccups in the process. It extends the closing time. There's a lot of hoops to jump through in regards to that. So, I mean, if it's the only way to get into a home and that's something that they need to do to accomplish that, we're more than happy to help. But if there's any other way around it, I would highly recommend staying away from having to go that route.
Got it.
But that's a big thing there too, is it's not that like shelter is offering this directly, so it's just as easy and smooth as the rest of the shelter loan is. It's sort of like a separate product that they could help get in contact with. But unless your new programs are different, typically it's like it almost feels like it's a separate lender.
Yeah, it is. It's a third party. So like, for instance, when I did a Georgia Dream loan with my previous company, we were clear to close in, I think, 16 days, and we couldn't close until day 35 because Georgia Dream, it took them 3 weeks to get it out of underwriting.
Mhm. Very common.
And it wasn't like it was a trick. It was 800 credit score, was employed for 3 years consistently with a salary. It's not like it was a crazy file. It was pretty
Sure.
pretty
Simple,
straightforward.
yeah.
Yeah. So with that being said, if it's possible to not go that route, then I would recommend that. But if that's the only way to do it, then, you got to do what you got to do. And we're more than happy to help with that as well.
Cool. Thank you.
Yep. Y'all have a good one. Call or text me if you guys need anything. Thanks for stopping by.
Thanks, Hunter.
Hunter.
You got it.